After 30 plus years in finance, 10 of which were doing debt collection, there's one thing that I can say with confidence. Most people do not understand how credit works, how credit scores work. I'm going to share some hints and tips and some shocking guidance on how to improve your credit score. So my name is Anthony Lindsay, and I've been in finance for over 30 years, so I know a thing or two. I'm going to go through the top three questions that I get asked about mortgages, specifically around credit. So, question number one is, what credit score do I need to be approved for a mortgage? Another question I get asked frequently is, why was my mortgage declined? And probably the third most asked question is, why are interest rates so high? So, as I said, I've been in finance for over 30 years. I've done everything from debt management to wealth management to lending. So, I approach mortgages and debt management and credit in a very different way than many people who have just worked in one discipline. As you know, your home may be at risk of possession if you do not keep up your mortgage repayments. So, very simply put, you have to think about it. Every single mortgage is going to come down to three things. I call it DIC. So, it's going to come down to your deposit, your income, and your credit score. So your deposit, your income, and your credit score. We'll talk about strategies that we can use to improve each of those things. We'll be talking a lot about your credit, but we'll also be talking about the deposit and the income. One thing to keep in mind, and this is something that I discuss frequently, is there's a difference between your credit score and your credit profile. So your credit score is a numerical output. So it's a number, might be 700, 750, 800, 920, whatever. That's very different than your credit profile. So if you think about it this way, someone usually that has a high credit score will probably have a strong credit profile. But that's not always the case. I've had instances where I've had clients who have a high credit score, but because of missed payments or late payments, their credit profile is not as strong as someone who maybe has a lower credit score. So it's important to remember that if you have missed payments or late payments, for some lenders, they will not consider doing a mortgage for you if you've had a late or missed payment within the last 6 months, 12 months, 24 months. Every lender is going to be a little bit different, which is one of the values of going to a broker. A broker will be able to look at each individual lender's criteria and understand who will accept a mortgage based on a missed or late payment, CCJ, defaults, credit issues in the past. If you want to improve your chances of getting the best mortgage, if you do have any defaults, you want to make sure that you pay them off. So on your credit report, what you'll see is that you had a default, but it will show as satisfied. That means you've paid it. The moment that that account defaults, it's done the most damage that it's going to be able to do on your credit profile. However, if you can satisfy that and put some distance between when it was satisfied and when you apply for credit, it's going to give you more options as far as lenders. When we talk about credit cards, so we're talking about credit cards. Credit cards are one of the best ways of improving your credit profile, but only if they're used with discipline and only if you're pragmatic and you do the right things. So as a parent, a lot of people will tell their kids when they go into university, do not get a credit card. Don't get a credit card. It's not always the best advice to tell our young adults not to get a credit card, because when you don't have any credit, you don't have a credit profile, you probably don't have a good credit score, it will make it more difficult for you to qualify for products. So if you get a credit card, here's some great tips and some great ways of improving your credit score using a credit card. When you get your credit card, make sure that you don't pay off the full balance before the statement date. But I'll get in a little bit more into that shortly. So after you've had the credit card for a while, you might find that the lender or the credit card company starts to offer you credit line increases. Now, people who want to be really disciplined and don't want to get themselves in any credit troubles or any issues with their credit, they tend to not accept those credit increase offers. Now, this is a mistake. And this is one of the things that seems counterintuitive. But if you get offered a credit card limit increase, accept that credit card increase. And I'll explain why. When lenders are looking at your overall credit profile, they look at a snapshot of how much available credit you had when you first started getting credit cards for maybe a specific credit card. So let's just say you have a Capital One card and they started your credit limit at 500. They offered you credit limit increases that you did not accept, and you continue to have a $500 or pound limit. The credit card companies will look at that and say, well, why has this person's credit limit not increased in 1 year, 2 year, 3 year, 5 years, whatever period of time you've had that credit card? What they want to see is that your credit limit is increasing. That will also help you with what's called your utilization, which is another hot topic that we will be covering. But by accepting those credit card increases, it shows that you are credit worthy. It shows that people want to lend to you. Now, some lenders don't automatically offer credit limit increases, so you have to request them. So as a rule, what you can do is request a credit limit increase every 6 months. Some lenders, it will be a shorter period of time, especially the credit profile builder cards like Vanquish, Aqua, the lower level Capital One credit cards. So request a credit limit increase if you're not getting offered those increases. So credit limit increases and increasing your credit limit is one way of improving your credit score, believe it or not. It seems and sounds like something that would not help you with your credit score, but it absolutely will, as long as you are making your payments on time and not letting the balance just roll over month to month. The other thing to consider is when to pay. Now, I mentioned about not paying off the full balance before the due date. So what a lot of people will do when they're trying to build their credit profile is they'll go out and get a credit card, which is great. Go and get a credit card if you're trying to build your profile. Then they'll make purchases on the credit card and then pay it off right away. So let's just say they make the purchase on the 1st or 2nd. Then they'll see that it's showing on their balance. What they'll do is they'll pay it off. Now, the reason why this will not help you with your credit score is because there's 2 key dates that you need to remember with a credit card. They're usually different dates. They can align. In some cases, in some instances, you can ask them to align. But the 2 key dates are your statement date and your due date. So your statement date and your due date. So the statement date is the date that the statement for that credit card is produced. The due date, especially if you have a direct debit, will probably be about 14 days after the statement date. The statement date is what reports to the credit reference agencies. So again, if we use that scenario, you've used the card on the 1st, you pay it off on the 4th, and your statement date is on the 15th, by the time it comes around to the statement date, you have a 0 balance. So it looks like you're not using that card. The other danger of that is a lot of lenders will start to reduce your credit limit based on the use of the card. So if you're not using it, they will reduce that credit limit. They may even cancel the card. I know years ago when I was buying my first property, I was like, okay, I'm going to clean up my credit. I'm going to pay off all my credit cards. I'm going to make sure that I have a 0 balance on all of them. And it took a while to come up with the money. So I didn't have a balance on those credit cards. I wasn't missing any payments because I didn't have a balance on those cards. And I got a notification one day that they were closing the account. I know Barclays card in the UK is notorious for reducing people's credit limits when they're not using that credit limit. So make sure that you're using the card, Make sure that you do not pay off the full balance before the statement date, and then make sure that you have a direct debit to set up to make the payments. But within that whole mantra or that methodology of leaving some a balance on the credit card for when the statement date comes around, make sure that you're not utilizing too much of the available credit. So what I mean by that, let's just say you have a credit card and that credit card has £1,000 limit and you're using £100, that would be 10%. If you're using £500, that would be 50%. A very safe area to be that shows that you're a responsible borrower would be around that 10% mark. So if you go up into 60, 70, 80%, that's starting to show some red flags for lenders. So to summarize that point, when you have a credit card, use the credit card. Otherwise, you're in danger of them either reducing your limit or actually closing out that account. Do not pay off the full balance before the statement date. Make sure you lower that balance to 10% or lower. I would say between 3 and 9% of the total credit card balance. And make sure that you always make your payments by the due date. So you get your agreement in principle, you start house hunting, and then you come back to me and we can get you that purchase started. My name is Anthony Lindsay, and I'm here to answer your questions. So if you'd like to book an appointment with me, you can use the QR code. You can read the information in the description, and you can get in contact with me. Consultations are free. I love working with complex cases. So people who maybe have had some credit bumps, people who are first-time buyers, people who are on skilled worker visas, people who are self-employed or contractors, all of that weird and wonderful stuff. The straightforward, high income, UK passport, high deposit, those people are great people too, but I love being able to help people who didn't think that they would be able to get a mortgage. I'm launching something that hopefully many of the people that watch this will find very valuable. I'm launching something called the Mortgage Ready Challenge. The Mortgage Ready Challenge is for anybody who's planning on purchasing a home within the next 6 months. So the idea is, as of the airing of this video, you'll be mortgage ready by summer, that you can be in your new home by next Christmas. So that's the Mortgage Ready Challenge. The benefits of the Mortgage Ready Challenge are A, we will get you in a position to get you the very best mortgage based on your circumstances within the next 3 to 4 months. So we'll help you clean up your credit, we'll help you increase your income, and we'll give you some tips on how to increase your deposit. The Mortgage Ready Challenge will also enable you to have lower broker fees. So if you come back to me within the next 6 months and I do a mortgage for you that goes to a full mortgage offer, you'll get 50% off my broker fees. You'll also be a part of our private group that we support each other. It's a business networking group where we'll help you if you're looking to do a side hustle, if you're looking to generate some additional funds, if you need support in building your website or getting your business out there or finding clients, you'll be able to do that. You'll get additional resources. We'll have some training on some property strategies, because let's face it, people often feel that they have to get a mortgage because they have to own, because they feel that everyone should own a home. Having a mortgage and owning a home is not right for everybody. There are some downsides to owning. So keep in mind, when you own your home, unlike renting, when you're renting and you have a leak or something goes wrong, you call the landlord. When you own, you're responsible for that. So there's additional expenses that come along with owning your home. So we have courses that we go through other property strategies. You'll have access to those courses. You'll have access to credit tips. You'll have access to just a ton of information. So the goal of the Mortgage Ready Challenge is not only to get you mortgage ready by summer, that you can be in your new home by Christmas, but the other point of the Mortgage Ready Challenge is to increase your income, decrease your outgoings, and build up a bigger deposit that you can get the very best mortgage. My name is Anthony Lindsay, and I hope to speak to each of you at some point. I appreciate all of your time, and I appreciate you tuning in. Make sure you look at the description in the information in the description. All my links are there. I'm on LinkedIn, I'm on social media, and I'm here to help you. So if you have a first-time buyer question, if you have a credit question, if you just want to speak to someone that's going to give you honest advice on how to buy your home, remortgage, do a buy to let, make sure that you reach out.